Happy Friday, Brian Manning here with the weekly update. Let's get right to it. First of all, actually, I want to say thank you, everyone, so much for coming out making Fall Fiesta incredible success. It was our ninth year doing it. Phenomenal to have such a successful event. Incredible to see so many smiling faces. We had a really wonderful time. Thank you, everyone. Thank you very much for everyone that came out. Let's talk about what's going on in the markets because we got a lot to talk about this week. So Monday was a relatively quiet news day leading into Tuesday because Tuesday we got CPI report. This is a consumer price index. This is one of two gauges of inflation on the retail level. Very important for us to look at. Let's take a look at the charts just to get some feedback here of where we're at. Bear with me for one moment, please. Okay, so this is CPI consumer price indexes for the month of October. The second inflation gauge we're going to get is called PCE. That's the personal consumption expenditure. That comes out about 2 weeks later, but the CPI report kind of leads us into this PCE, and the numbers usually fairly similar. So we look at this for the month of October. So in the month of October, we had the headline number move lower from 3.7% down to 3.2%. So that was a really good move lower. And then we had the core rate that excludes volatile items such as food and energy, and that moved from 4.1% down to 4%. So really good to see a meaningful move here. Inflation is just the enemy of mortgage interest rates. As inflation moves lower, mortgage rates move lower. And it's just something very important for people to understand. So if we look at what's going on in the marketplace and why were these numbers impacted? So first of all, we have shelter costs. We've talked a lot about shelter costs over many of these updates. Shelter costs moved from being up 7.2% to only being up 6.7%. We'll look more at that in a moment, but it really seems like we've seen the shelter cost peak and they're moving lower. This is important because this makes up almost 44% of the reading. That's a huge number. We have rents. Rents move lower from 7.4% down to 7.2%. That's really important. Another big one we saw move on is what's called owner's equivalent of rent. So that's like saying if you were going to rent your home, how much would you rent your home for? And that moved from being up 7.1% to being up 6.8%. Also, a really impactful number this time is what's called this lodging away from home. So in prior months, lodging away from home, that's like hotels, Airbnbs, etc., that number was going up. But travel has definitely cooled. I just read an article in the journal the other day that, flights are cheaper. Everyone was going to Europe over the summer, and now, the travel is down. And over summer months as well, we saw this lodging away from home number increase because hotel accommodations, Airbnb, VRBO, etc., were all at higher numbers as far as utilization rate is concerned. Those numbers are coming down. And this is pretty impactful. So now this is down 2.5%, whereas in the prior reading, I think it was up like 3.7%. So that's very impactful as well. Energy is down. That's because you're seeing oil prices lower. Airfares are lower. There's two numbers in here that I'm not really sure. Actually, let me back up one. Sorry. Used vehicles, this is good to see move lower. During the pandemic, used vehicles were actually appreciating in value. That's not normal for an average vehicle to go up in value. So it's good to see those numbers move lower as they should. Used vehicles are usually going to be a depreciating asset. So this is pulling more in line. This is cooling inflation numbers as well. Two numbers that are in here I just don't agree with, but they are in here is motor vehicle insurance. Damage is up, car thefts are up, motor vehicle costs are going up. No matter what the Federal Reserve does, no matter how much they hike interest rates, they go to 30%. That's not going to impact all of us as consumers needing motor vehicle insurance. That doesn't impact, thefts, damage, etc. And then healthcare. We have healthcare in there as well, going up 1.1%. So overall, really good to see improvement in the inflation numbers. We've looked at this before. I do want to look at it again because shelter makes up almost 44% of this reading. It's a huge number. So if we look at shelter and core logic, we look at what's called blended rent. So blended rents is new rents. So if you're going to go rent a place, how much are rents going up for new leases? And then it looks at renewal. So blended rents, when you blend those two together, shows that rents are going up at 2.9%. So this is down significantly from the peak. But if we look at the CPI number, that's at 6.7%. We've talked about this a lot in the past because CPI looks back 12 to 16 months since rents are typically on an annual basis. And we really have seen that crest there, and we're starting to see rents move lower. So what's interesting is that CPI right now is at 4%. If we actually took this true number, we have this lag effect. If we took this true number into account right now, real inflation right now is actually at 2.3%. So definitely in the Fed's direction of the target they're going for, definitely in the direction of 2%. This probably to us would mean Federal Reserve's not going to hike rates in December. They're probably going to be done hiking rates, even though they have a tough talk right now. My guess is that they're done, depending on economic conditions and what happens. Now you're starting to see investors bake in like a 35% chance of a rate reduction in March, 65% in May. So depending on what happens economically with recessionary pressure, that's going to have an impact on it. What's interesting is, we've talked so much about shelter and CPI. We've been talking about these numbers coming down. And here this week was an article in the Wall Street Journal talking about rents cooling, and this is going to impact inflation. So really good to see, even the news channels in line with what we have been talking about lately. Let's see what else we have this week. Wednesday this week, we had PPI. This is Producer Price Index. This measures inflation at a wholesale level. This was dramatically lower than expectations on a year-over-year basis. Instead of going up at a rate of 2.2%, it's going up at a rate of 1.3%. That's important because when inflation cools at a wholesale level, it could mean that cost passes on to us as consumers at a lower level as well, because the cost to produce goods are less at a wholesale level. We also got some employment information, which I think is really important for us to talk about this week. So Federal Reserve is looking at cost of goods, they're looking at inflation costs, but they're also looking at employment. They want to see a softening in the labor market. And it's anticipated right now that there's going to be an average of about 40% less hiring for seasonal employees coming into the holiday season. And that's impactful because if you don't have this, insane hiring process going into the holidays, then you're not going to see a giant boost in employment. And when you have inflation numbers coming down, softening in the labor market, it's going to show potential recessionary pressures, and it's really going to get the Federal Reserve to really look at what's happening with rates, probably stop hiking rates, and then look at when they're going to have their first rate cut. This is really important to look at rate cuts and start talking about that now, because right now, the Federal Reserve is doing what's called quantitative tightening. So they have this balance sheet that's trillions of dollars of mortgage-backed securities and U.S. Treasuries. And right now they have it's called the runoff of the balance sheet. So they're selling mortgage-backed securities and U.S. Treasuries. It's kind of putting a glut of inventory into the marketplace. But at a point in time when the Federal Reserve starts to lower rates, then they have to stop their quantitative tightening. If you don't stop it, it's almost like driving down the road with your foot on the gas pedal and the brake pedal at the same exact time. It's kind of counterproductive. So at some point in time next year, you're probably going to see the Federal Reserve cut interest rates. When they do that, they're then going to stop quantitative tightening. That's then going to reduce the amount of inventory going into the marketplace for mortgage-backed securities, which is also going to drive rates yet even lower. If you're a home buyer, I think right now is the phenomenal time to buy a house. When you see rates move lower next year, you get into the spring, it's going to be the frenzy of the home buying season, mortgage rates coming down. It's going to have higher demand, limited inventory. We all know how that's going to go for us. Today, relatively quiet news day, not a lot to talk about today. I'm available all weekend. I'm available all week going into Thanksgiving. If you have any questions, if you want to learn how we're closing purchase transactions in 10 days, start to finish, give me a call. I'd love to help you. Happy Friday. Have a great day.